Ladies and gentlemen, sorry to disturb you again, but it's the last disturbance for the evening. I hope you had already good talkings. But we want to come now to our keynote speaker, a good friend of mine, Ronald Stöferle from Vienna, directly here for you. And he is, together with his partner Mark Warlick, the chief editor of this lovely report you might know. In gold, we trust. Of course, we do that all. Honestly, believe me, that's a lot of work behind this. They are doing an amazing job. They bring this up all the time, every year in the summer. And it's fantastic information in it and really worthwhile to read. And also they are doing a huge chart book on everything. So something you really should have and you really should go through. And Ronnie is also a fund manager, analyst. They are running 5 funds in the resource space altogether, and they're doing a tremendous job here out of Vaduz of Incrementum is your company. And also he's a very lovely speaker, because I thought we are late in the evening and it would be fantastic to have a speaker here who is doing a, let's say, a little bit dry theme like gold, a bit more from the, let's say, fun side, but garnished with fantastic information. And that's who you are. Ronnie, welcome. The floor is yours. Thank you.
Thank you, Jochen. Sean Rosen already made a few jokes about his trousers. And actually, Jochen and I, we had a bet, a wager, because I presented at a conference in Stuttgart. And I said on stage, I'm really confident that gold will rise. If it won't rise in the next year, I will put on Jochen's trousers.
Yes.
So we should really pray for higher gold. I think his trousers are like 1 or 2 sizes larger than mine.
Maximum 2.
Let's pray for it.
And by the way, the date is 13th April next year. Look forward to that.
Yeah, Patrick, Michael, many thanks for inviting me to this beautiful venue. I actually spoke at a couple of interesting venues at an Irish pub, but also the cathedral in New Zealand. But this one is just magnificent. So thank you very much for the invitation. It's really a pleasure being here today. The title of my speech is In Gold We Trust, or Why We Might Be Expecting Too Much from Gold at the moment. So let's get started. I'm only 37 years old now. I've got 3 daughters, so 4 women at home. I'm really used to suffering. I'm used to stress. So I've got a few lessons from life that I've learned so far. First of all, life is all about timing. Mr. Greg Schön, I wish I had kept my 1,700 Bitcoin at 6 cents instead of selling them at 30 cents. Now that they're $8. Mr. Greg Schön posted that on 17th of May 2011. So he made a profit of $500 on that trade. Now those 1,700 Bitcoin would be worth 12 million. But I shouldn't make jokes on him, because I am quite an idiot as well. I sold Novo Resources at 150. So I'm suffering quite a lot from hearing from Heinz Isler, for example, about Novo and having a look at the stock price. And the second lesson is life is all about expectations and managing expectations. How I think I look while driving and how I actually look. Another expectation now, probably the man will wake up. But that's reality. And my very favorite one, this poor guy. So what does it all have to do with gold? Adrian Day, an analyst that I respect quite a lot, he said at a conference that people are actually expecting too much from gold at the moment. Why is that an important point that he's making? Stocks are rallying. We've got volatility at an all-time low. We've got real estate all over the globe doing extremely well. We've got bonds trading close to all-time highs. We've got trust in financial system and banks, and even politicians is back. We've got low price inflation, at least the way, traditional economists measure inflation. We've got the Fed raising rates and implementing quantitative tightening. And we've got cryptocurrencies stealing the show. Last week at a big conference in Munich, the Precious Metals Conference, Edelmetallmesse, there used to be, I think, 20,000 people back in the old days on 2 days. This time around it was much less, and 50% of all presentations was merely about Bitcoin and cryptocurrencies. Now I just read on Zero Hedge that the Google searches buy Bitcoin is more popular now than the Google searches for buy gold. So I think that cryptocurrencies are definitely stealing the show. When I'm talking to journalists, say, I've got an interesting thoughts on gold, say, I don't care about gold. You should publish something like Bitcoin 20,000 and then I'm going to write the story. From my point of view, I'm not against cryptocurrencies. I think gold and cryptocurrencies and Bitcoin especially are both, I would say, anti-government. So investors that have got some slight doubts about the reliability of central bankers to really preserve your purchasing power. So from my point of view, I'm totally fine with cryptocurrencies. I think in a Hayekian way, competing currencies, that's fine. But the cryptocurrencies are, from my point of view, stealing the show from gold for the time being. So we should not forget the environment for gold is not extremely positive. We've got lots of headwinds. And I'm going to talk about the headwinds that will become tailwinds in this presentation. So macro picture, where are we now and where are we going? Warren Buffett said, the bull market is like sex. It feels best just before it ends. Now, I think nobody wants to think about Warren Buffett having sex, but of course, he's a great investor, and I truly read everything that he actually writes. Just to give you some perspective, you all know those numbers. This is what we call monetary surrealism. Those are the balance sheets of the biggest central banks. Since 2008, they basically tripled. And just to give you a sense for the amounts, just to give you a perspective, only in the first quarter of 2017, the biggest central banks created 1 trillion, so 1,000 billion US dollars out of thin air. To give you a perspective, just in 1 quarter, 1 trillion. You could buy for every human being, it's like 8 billion people nowadays, you could buy over here in Zurich, which is based on a Big Mac index, the most important, the most expensive country, you could buy 20 Big Macs for every human being. Or you could buy 1/10 of an ounce of gold, which I would recommend. So those numbers are just staggering, but we're not really seeing that it's feeding into gold. So this correlation that we have seen, this positive correlation, rising central bank balance sheets, rising gold prices, it basically broke in 2011. And what we're facing now is what we call the everything bubble. So 99, 2000, we had the dot-com bubble. Back in those days, actually industrial companies were trading pretty cheaply. It was only a small part of the economy, of the stock market that was ridiculously cheap. Then we've had the housing bubble, but now we're in the everything bubble. So real estate prices, equity markets, bond prices, and art and all that stuff trading at or close to all-time highs. So I don't know if you're familiar with the Austrian School of Economics, so I could also call it common sense economics or the no free lunch school of economics. The Austrian School of Economics says that inflation means basically a rising money supply. The next stage is asset price inflation, and only the third stage is price inflation, consumer price inflation. this inflation that all central bankers and politicians desperately want to create. So they are saying inflation is still too low, and I say no, it's not too low. You've just got the wrong definition of inflation, because we're seeing massive monetary inflation, we're seeing massive asset price inflation. So probably the next stage is gonna be declining purchasing power based on those consumer price inflation numbers. And this leads to irrational exuberance. CNBC, for example, saying the best move, just buy everything. We're seeing lots of complacency in the markets at the moment. Deutsche Bank just gave out a spectacular report saying that based on their measurement, they're creating, or they calculating an index, 15 developed markets, country average bond and equity valuations. It's at the highest valuation level since 1800. Of course, this is also the inverse of rates. As you know, rates are based on the Bank of England and their research on the lowest level in the last 5,000 years. But as you can see, those valuations are pretty lofty, and this also means that we're extremely sensitive and fragile when it comes to rising rates. And this creates, and I hope you already had a few glasses, then you think it's gonna be funny. I thought about that when I attended a big conference with lots of institutional players. And they said, you know, we're managing, I don't know, double-digit number of billions Swiss francs. And I say, you know, we know those valuations, they are ridiculous, but we will get out before the market crashes. And I said, okay. It reminds me of my friends sitting in the pool, sipping a few beers, and thinking, why not have a barbecue? And then you've got this extension line, then you've got those flip-flops, and it's just not a good idea. And there are moments in life when you should think, that's not a good idea. I just should step out and reconsider this situation. And there's plenty of those things. Well, those pictures are from the Darwin Awards, a site where there's nominations for people who basically kick themselves out of the gene pool. But what I wanted to say is, despite all those headwinds and all markets basically rallying and nobody really caring about gold, gold is actually doing pretty well. It's up 10% in dollar terms. It's up in Swiss franc terms. It's up 7% since the beginning of the year. It was up last year in dollar terms, 9.1%. It was up in euro terms, 12%. This year it's a bit flattish as the euro is getting a bit stronger. So gold is actually doing pretty well, but nobody really cares about that at the moment, which is a good sign from my point of view. Now, let's have a look at the biggest opportunity costs, stocks from my point of view. What we're calculating here is a gold S&P ratio, basically showing if the ratio falls, stocks are outperforming gold. We can see that since 2011, 2012, this ratio was falling, so stocks were massively outperforming bullion prices. But now, since the beginning of 2016, it's actually kind of building a base, it's leveling off, and it's already above this 200-day moving average. So from my point of view, this ratio will tick up, so gold will show increasingly rising relative strength versus stocks. And the second chart, I think this was the most popular chart in our last gold report. It shows a ratio of the GSCI commodity index, total return, versus the S&P 500. And it clearly shows that there's large cycles. And it shows that at the moment, on a relative basis, commodities are as cheap like in 97, 98, or in 1971. So normally, there's mean regression happening in markets. If we would just go to the median, it would be 4.1. At the moment, we're trading at a ratio of 0.5, something like that. So as you can see, on a relative basis, commodities are just dirt cheap compared to stocks. Now, headwinds will become tailwinds. And the most important drivers from my point of view are recession and inflation risks. Ray Dalio was already quoted today, and he said, the two main risk factors for the average portfolio are less than expected growth and more than expected inflation. Now, this is a chart that we also had in our last gold report. And actually, we had a look on Bloomberg, the analyst forecasts by the 89 most important economists. So the economists working for the biggest banks, for the biggest institutions, those guys with 8 PhDs running extremely complex econometric models. We had a look at their economic forecast for the next 3 years, and actually there's some herding behavior, I would say. So who's expecting 2017, 18 or 19 a recession for the US? 0. None out of them, 89. We checked that for the year 2007. How many analysts predicted a recession? 0. So what I want to say, I don't know if there's going to be a recession in the US next year or the year after, but if there's recession fears coming up, this will have huge impacts on financial markets because nobody expects at the moment that recession fears might come up. And actually, a recession from my point of view is something just normal, something healthy, because it's a reallocation of resources. The longer you try to avoid a recession, the worse it will get. And actually, we had a look at the hiking cycle since 1914. So we had 19 cycles where the Federal Reserve raised rates. And out of those 19 cycles, 16 ended in a recession. Every financial panic, before every financial panic, we have seen rising rates. Actually, from my point of view, the tightening already began in 2013 when Ben Bernanke announced tapering. So we're already in this tightening game for quite a lot. So from my point of view, it would be absolutely normal to expect a recession sooner or later. And we're having a lot of numbers showing us that we're probably in a very late cycle phase. This is, for example, gross tax receipts massively diverging from the S&P 500. We've got auto sales, we've got credit growth being extremely sluggish, we've got consumer credit being really weak at the moment. So from my point of view, recession fears might come up mid next year at the latest. But what does it all mean for gold? We crunched the numbers, and actually recessions are a great environment for gold. So on average, the performance in the last recessions since the 70s, it was 20%. Why does gold do well during recessions? Because gold discounts that central bankers will lower rates, will introduce monetary stimulus, that there will be fiscal stimulus by politicians. So this is all discounted by the price of gold because we know that politicians won't just say, okay, we've got a recession, we won't do anything, just let the system cleanse itself out. So recessions are a pretty positive environment for gold. And the next thing, the next big driver for gold might be inflation, rising price inflation. At Incrementum, we calculate our inflation numbers. We've got a proprietary inflation signal. We don't care about those CPI numbers, PCE numbers, and so on. We calculate it in our own way what the market is telling us, if the market is seeing rising or falling inflation. And actually, since I think 4 weeks ago, we've got a rising inflation signal. So Most of the people here are interested in gold, but especially in mining stocks. Who of you has seen the movie Rocky IV? Only a few people. I think it's one of the best movies ever. And Rocky, I quoted Rocky Balboa in my gold report, but I also quoted Homer Simpson, for example. He said, going in one more round when you don't think you can, that's what makes all the difference in your life. And that was basically the motto for the chapter about mining stocks. So have a look at this movie again. Nobody cared about mining stocks. Nobody thought that Rocky would win this fight against Ivan Drago, the bad guy from the Soviet Union, and then after 12 rounds, and he actually would have to be dead like 3 times. Everybody who knows something about boxing knows how ridiculous the scene is, but it's just a good classic movie. Many people think that the mining sector is dead as well. We crunched the numbers for the gold bucks index and thought it's quite spectacular, actually. The free cash flow of the companies in the gold bucks index was in 2016, it was higher than in 2011. 2011, gold was on average trading at 1620. Last year it was trading at 1244. And we still had higher free cash flows than in 2011. So I think the mining companies, most of them, really did a great job. They consolidated, they brought in new management, they got leaner, they cleaned up their balance sheet, they got their share structure under control. So from my point of view, the mining sector has got much greater leverage on rising gold prices than ever before. And Rick Rule today said that every bear market is the foundation for the next bull market. Let's have a look at this bear market that we experienced. It was not only the longest bear market in mining stocks, it was also the bear market with the biggest, by far the biggest drawdown. And this number is since 1939. So that's for the BGMI index. So we've experienced in the last couple of years the longest and the most brutal bear market. And this kind of suggests that the next bull market should be big fun. So when do you actually buy Christmas decoration? Most people in November, December. My wife always buys it in January. And at the beginning I thought, why do you do it? I mean, Christmas is still a couple of months on. But it's off 50%. But still, nobody's actually doing it. And when it comes to the mining stocks, this bull market has legs. We're only here. So it would be kind of weird and unusual if this bull market, after the longest and most severe bear market, would be so short. And you can also see that every bull market, at the very end, we're seeing this mania phase, this extension phase, where everybody is going crazy about it. And at the moment, this is still, seems like a small, quiet, private party in the mining sector. So that makes me pretty confident. The outlook, Karl Popper said, in an economic system, if the goal of the authorities is to reduce some particular risks, then the sum of all these suppressed risks will reappear one day through a massive increase in the systemic risk, and this will happen because the future is unknowable. What does it mean for gold? First of all, safety first. People are often too much focused on safety, but I think these days, with all those monetary surrealism happening, with central bankers putting us into huge monetary experiments, safety first. And it also means, from my point of view, you've got big safety in gold and also in the mining stocks, because gold is, if you measure it or if you value it as a monetary asset, it's dirt cheap. What we're doing here is the US monetary coverage ratio. So basically, how strongly is a US dollar backed by gold? And we've seen it in the 70s. The US dollar was backed by 70% of gold. Then 1999, at the bottom of the market, almost none. And now the coverage ratio is at 8%. So with all this money printing happening, actually gold got significantly cheaper. People tend to forget that because they only follow the nominal price. And now, are we on time? Yes, I think so. The conclusion. What do I expect? First of all, the current environment is not exactly favorable. We've got lots of headwinds. We've got an environment where other asset classes look more attractive. But still, gold is up 10% and gold is rising in basically every currency all over the globe. If the normalization of monetary policy does not succeed, what I expect, gold will pick up momentum. So as soon as the Federal Reserve will make a U-turn, we'll start talking about lowering rates again or perhaps implementing another round of QE. I think this is the moment when gold will hit 14, 15, 1600 pretty quickly. Price inflation might surprise on the upside. We've got oil prices looking pretty solid at the moment. We've got political events. What's happening in Saudi Arabia makes me really, really cautious at the moment. We've got North Korea. We've got so many political crises. We've got wage inflation picking up. And actually, as I've said before, politicians and central bankers, they want higher price inflation. I'm just not 100% sure, as I've studied monetary history, that they will really keep the genie in the bottle, that they will really be able to control price inflation, because the monetary system does not work like a thermostat. It's a dynamic system. So price inflation might get out of control. Mining stocks are in the beginning of a new bull market. We've seen creative destruction has taken place. And from my point of view, the leverage on higher gold prices is higher than ever. And I'm not only bullish on gold, I'm even worse, I'm also bullish on silver. So finding a silver bull these days is really not easy. But from my point of view and studying bull markets, normally within a gold bull market, the gold-silver ratio does decline. So silver is outperforming gold. So from my point of view, silver mining stocks are in particular interesting. So that's it. I very much enjoyed it. I hope you enjoyed it. And thank you very much for your time. Thank you very much. Questions?
Thank you very much on that. And yeah, any questions from the audience, please? Sean?
Up until recently, being a prince in Saudi Arabia was probably the best career choice you could make. Where do you think this thing is headed? I mean, obviously there's a chance to move a huge amount of wealth and really sort of change the dynamics of that whole Gulf environment, which has, been one of the drivers of gold. But where do you see all this sort of setting that sort of predicts the transfer of wealth heading and taking us?
Well, I honestly didn't follow the news coming out of Saudi Arabia too much, but what I think, there's a huge risk that this will not turn out as the Crown Prince wants it to turn out, because it's a huge family. I think it's 150 family members. But we have to say that the whole region is a powder keg at the moment, and it's a big mess. We've got the wars in Yemen, we've got the Qatar crisis. But perhaps from a more broader perspective, I think we've got geopolitical crises all over the globe. Jim Rickards, who is on our advisory board, he's absolutely certain that there will be a military crisis with North Korea next year. He says first half of the year, 2018. From my point of view, all those military conflicts are basically a consequence of the economy not doing so well. And all this populism that is coming up on the right side and on the far left side, that's basically a consequence of our economy. Reading statistics by the, I think it was put out by the Bank for International Settlements. They had a look at the average household income for the G10 countries. And in the last decade, the real household income declined in 80% of the richest countries. So this is, from my point of view, the reason why we're seeing populism. This is the reason why we're seeing political crisis turning up. And this makes me a bit scared, honestly. Does that kind of answer your question?
There's one down there.
Ronnie, Paul Burton. Congratulations, excellent presentation, very entertaining. I think for an Austrian, you have a very English sense of humour. You show one slide about the free cash flow of the mining companies, greater now than in 2011. I accept that, but I think we have to look at why those cash flows are greater. They've cut back exploration and development so much. Now, while that might in the longer term be a good thing for gold, it's not particularly going to be a good thing for individual companies. So would you like to make a comment or observation on that?
No, I absolutely agree. I mean, how could I disagree with Paul Burton? That's totally right, and that makes me pretty confident regarding M&A activities sooner or later. And I think what's really positive, what we've seen quite recently with a few takeover announcements, that actually the companies buying other companies, their stocks were doing pretty well, and that shows me that the market is appreciating good deals again. But I totally agree this will cause problems in the future, because there was not enough exploration, but the market probably will solve it via M&A deals.
Yes, one here, and also one here, Patrick. Yes, please.
So my question is about gold relative to other assets. And I think in the 80s, the gold holdings in percentage of a portfolio was about 15%. Today, it's not even 1%. And the idea is, if only a small portion of the bond or equity money is spilling over into gold, it could be an explosion. What's your thought about that?
Of course. I mean, I think in 1980 it was 12%, something like that. Of course, that will have an impact as soon as stocks will roll over, as perhaps sometimes even real estate will roll over. This will have a tremendous impact on gold holdings sooner or later. But we should not forget that the market is quite different. Back in the days, you didn't have a choice buying, so many different assets. Yeah, so back in the days, everything was a bit more basic, and you didn't have so much choice in allocating your assets. But still, if we go from 1% to 2%, it would have a tremendous impact on the price of gold. What I see at the moment, I used to work in a bank for 8 years. That's where I lost all my hair. So basically, they are trend followers, and it's in huge bureaucratic organizations. It just takes time to say, okay, bank XYZ is now recommending 5% in gold. At the moment, I think no bigger bank globally would really recommend like more than 3 or 5%, like ridiculous amounts of gold. In the bull market, 2011, every big Wall Street bank had price targets above $2,000. JP Morgan, I think $2,600, Citigroup, $3,000. So as soon as this bull market progresses, I think Rick Rule said today we are only in the third inning, which for an Austrian or a European, we don't understand baseball. So I don't know, in skiing it would probably be like after 10 seconds on the Streif, which is like the biggest downhill race, as you know. So as this bull market progresses, and if gold is trading at 1,400, 1,500, of course all the bankers will come out again and say, we always said you should have some allocation in gold. And then we'll raise it. then they will say at the peak of the market, they will probably say, we always said you should have at least 25% of your portfolio in gold. So I think that's going to be the way that it progresses, and that's probably add to the average holdings.
Yes, Ronnie here.
I am wondering about your indications on inflation. Of course, we have higher commodity prices, but we have also underlying indications or obvious indications that it will be different this time. I'm reminding you of Carmen Reinhardt. And my question is, wage inflation in the US is at 2% compared to last year. And inflation really is a problem, not only for the Fed, but also for the ECB and other central banks, apart from Great Britain, where we really have inflation, or China.
Your point being is that inflation is too low or too high?
Yes, too low.
Too low?
Too low. I don't really see, apart from high commodity prices, an impetus for higher inflation. Low growth, not really dynamic growth.
First of all, I think inflation is a bad thing. It's not something positive. Because if you're purchasing power...
It's good for gold.
Huh?
Good for gold.
It's good for gold, yeah. But I personally would like to have a sort of a natural deflationary monetary system. But within our monetary system, we need inflation. Because what would happen if there would be deflation? Asset prices would be falling. The income of our finance ministers would fall. So, and if you're over-indebted, deflation is like your worst enemy. So, from my point of view, as I've said, I've got a different definition of inflation, and we wrote a book, it's called Austrian Investing Between Inflation and Deflation. So, basically, if there wouldn't be any interventions happening, we would see massive deflation. And it would be brutal, probably. Would not be a good time. But the longer you avoid that, the worse it will get. And I think those things happening at the moment, desperately creating higher price inflation, while it's only popping up at real estate prices, for example. So I think an average household in Austria, for example, it's impossible to afford like a small apartment. It's ridiculous prices. I think that's something that we're seeing all over the globe. I think the gap between poor and rich is getting bigger and bigger, and that's a consequence of our monetary system, basically. So, from my point of view, there is inflationary threats. We're seeing wages actually in the US for skilled labor rising significantly. We're seeing commodity prices, and especially the oil price. That's a big question mark, because I think if you, like 1 year ago, if I would come into a room and ask like 100 people, what do you think, what's the oil price going to do in the next 3 years? I think 99% would have said oil will be trading between $45 and $55. It was such a strong consensus. Nobody is seeing oil going to $80, $90, $100. I can imagine it easily within a political crisis. So my fear is that inflation, at some point, the longer you push for higher inflation, the worse it will get. But as I've said, so far, we only got asset price inflation. But it also means that your purchasing power is shrinking. So if the purchasing power of my Swiss francs, US dollars, and so on, measured in real estate, measured in stocks, is shrinking, that's not a very good thing from my point of view.
Yeah, so that's it.
Sorry, but
Yep.
in my opinion,
Yeah.
inflation is very good for the state debt.
Yeah,
It's
sure.
declining.
Sure.
So it's very good. The state has less debt with a high
Of course,
inflation.
it depends on which side you are.
Yes, but if you are for the state, it's good.
Sure. We know that politicians they try to do everything, you know, financial repression and so on. And sooner or later, I think they will succeed, yeah. But that's not gonna be good for the average people. It's gonna be good for gold, but then, I mean, I cannot rule out that there will be taxes or even some sort of VAT on gold. I think they already got the plans for that.
Well, Ronnie, thank you very much. I have one last question to you, because I thought you lost your hair and your wallet with your 4 ladies at home, but that's obviously not the case. That's good. But one question, because you always do those predictions for the upcoming year. So what is your prediction on the gold price? Because I don't want to share my pants on stage in Stuttgart with you.
I think this video would go viral.
Exactly.
If we would be sharing pants on the stage. No, we're seeing 1450, something like that. We're seeing silver outperforming gold big time. So we're seeing silver at 22 next year. And yeah, we've made 10 predictions. Also, one of them is that there's going to be a huge crisis with North Korea. We said that we expect the Bloomberg Commodity Index to do really well next year. So, yeah. Should be a good year for us.
Perfect. Ronnie, thank you very much.
Thank you very much. Thanks.